George of the jungle, strong as he can be.
So what do you do if you are self-employed and you have a vehicle that you use for business? Do you take actual expenses? Do you take mileage? Or do you do something else? Well, if you've got enough prep time to be able to do this and you have a history of it, last year if you didn't do this, it's a little bit late, but if you can show that vehicle payment coming out every single month for 12 months from the business account that you are running all your other income expenses through, we do not have to count that in your personal debt to income ratios. But again, you have to have that 12-month history on there. Now, if you want to do actual expenses, you can do that, but you might want to compare that with doing the mileage deduction. There's a good app out there, MileIQ. It's not the only one, but that's the one that I'm familiar with and I use. And if you don't have a vehicle payment, or if it's a modest payment, that tracking your mileage, the good part about that is that the IRS allows roughly 40% of your total deduction to be categorized as depreciation. And depreciation can get added back into your income. So option A, of course, would be the 12 months of proof of payment through the business account. But if you don't have a payment, or if it's not being used so much for business that you want to call it 100% or what have you, those mileage tracker apps are probably better. So I would do the 12 months of proof of payment first, the mileage deduction second, and then last resort, actual expenses. Probably don't mess with it. So anyway, thanks for coming into thecreditjungle.com today. This is George Anderson, and I hope that helps you when you're looking to get your next loan. Talk to you soon.